So we're going to talk, I guess, continue on with finish up the rest of the hedge fund discussion. Which okay. So as I explained, there's not a whole lot to say about hedge funds other than the fact that they are local. They are not available to us in general. So it is restricted. It is by invitation only. Generally with high net worth individuals. They're the ones who come together to form hedge funds and hire a staff to manage monies. These funds are small, relatively speaking. Maybe a $50 million fund, a $100 million fund, which is minuscule compared to mutual fund sizes. But that also enables them to be very risky in their strategies in the marketplace because they want to earn monies for their wealthy clients. And that has also created some problems. As I told you before that initially the thinking was that these are rich people's playground, and so the SEC really had no interest in monitoring them. But then they realized to their horror that these hedge funds collectively were a force because they were, so you have a $50 million fund individually, but when you have a few hundred of these, then pretty soon you're talking a significant market cap in terms of size. And these were collectively creating havoc in the market, destabilizing the markets with their strategies. And so now they're pretty much under the radar. A lot of hedge fund managers have been sent to prison lately for illegal activities, insider trading, all kinds of stuff. So that's basically all there is to say really about. So this is a bit of a this is a bit of a somewhat of a I don't know what the right word is here, but a fund of funds is kind of interesting. So there's now so many mutual funds in the market that now you have collection of mutual funds that are called fund of funds. So you have a ton of funds being combined together as fund of funds, which kind of begs the question as to, diversification has gone to this level now that we are now diversifying across mutual funds. Mutual funds are diversified strategies to begin with. Now you have a second order of diversification going on. And so, and there are a lot of these fund of funds available, and you can look at them and see. The common knock on these things is that you're paying needlessly for diversification where it may be unnecessary, and so while they exist, and you have to make your own determination as to whether you want to get in on these things or not. But they're easy to spot in Morningstar and stuff. All you have to do is to type in the keyword "fund of funds" and they'll be pulled up. The idea is that they should have lower volatility, but it also comes at the expense of higher cost because of the diversity. You have different funds, different mutual funds being combined together, and so that adds to the cost, the management fees and things like that. So because you have many different actively managed funds being combined. And that means there's management fees across all of these funds. So when you combine them into a super fund, well, you've got internal component fees to think about, and that gets pushed down to the investor. So you have to ask yourself whether that added fee is worth getting into these stocks, these kind of funds. So how do you measure performance, right? With any investment, you need to be able to find a way to come up with a fund performance. Measuring performance, because you want to know how well your investment is doing, whatever that investment be. So in this case, some of the important ratios that people use to measure mutual fund performance, well-known beta measure, which is a measure of volatility and systematic risk in a stock. So you have stock betas, right? You have stock betas. You also have mutual fund betas because, well, guess what? Mutual funds are a combination of stocks. And so what the beta is really a measure of systematic risk. And again, for reference, the S&P 500 beta is 1. So the market beta is always considered to be 1, the reference beta. And so anything that's less than 1, so if a particular stock or a mutual fund has a beta less than 1, that implies that the risk, the systematic risk of that company is less than the market's, less than average, because market is considered average. And then if it's greater than 1, then it tells you that the beta risk is greater than the market or greater than average. So, so here's an example where a beta of 0.98, so a stock or a mutual fund that has a beta of 0.98 tells us that the fund is expected to perform 2% worse than the S&P index in an up market and 2% below, or 2% better in down markets. It should go the other way. Likewise, if it's 1.02, then it'll be 2% in the same direction. When the market goes up, the stock or the mutual fund is expected to go up. When the market goes down, it's meant to go in the same direction. So when you see a beta of greater than 1, it implies that that particular stock or mutual fund is considered to be riskier than the market, greater risk than the market. Okay, so here's another measure that's quite popular. It's called the alpha measure. Alpha is nothing but excess return. Okay, so excess return means, what is excess? Excess means return over and above market return. Okay, well, so return over and above what is expected. When the actual return is greater than the benchmark average return, then it has a positive alpha, and that's good. Alpha positive means that the fund has outperformed its benchmark index. So when a fund does better than the market or better than the benchmark, the alpha is positive, the reverse alpha is negative. So you typically want alphas to be positive, right? That means the fund is doing better than expected. And then R square, which is sort of like similar to beta. There's really not much difference. But R square, again, the benchmark is 100. So market-related parameters, market-related stocks, well, the index really, the market index would have a R square of 100. Something that has an R square significantly below 100 means that movements in that particular mutual fund are very slightly or not correlated with movements in the market. Okay, so when the market, if you have an R square of say 20%, that means that that particular mutual fund has very little movement, correlated movement with the market, right? So when a particular mutual fund is very close to 100%, that means that it's moving in lockstep with the market. So then the question becomes, why invest in that particular investment at all? Why not just take a position in a S&P 500 index fund, because you're not getting any added benefit. Okay, so, and then there's the Sharpe ratio. Sharpe ratio is really, as it's defined here, the portfolio return minus 90-day T-bill return, treasury bills. We'll talk about these very soon when we get to bonds. But for the moment, it suffices to know that the 90-day T-bill return is nothing but a measure of the risk-free rate. So it's the risk-free rate. So what is the return over and above the risk-free rate? Okay, and then divided by the standard deviation. So it's the excess return per unit of risk. The denominator is a risk. Standard deviation is a measure of risk. So, and keep in mind the 90-day T-bill return is nothing but a measure of the risk-free rate. Okay, so investors are advised to pick investments with high Sharpe ratios, because that means you are getting better bang for your buck. You're getting more returns per unit of risk, which is preferable to the other alternative. That's the answer to the why. All right, so that's as much as I wanted to say about what is a benchmark index and how is it set. Well, first of all, a benchmark index So if you are, and that's actually a pretty good question, there. There are many indices, as we talked about, right? There's the Russell 2000, Russell 3000, Russell 5000. There's the NASDAQ 100 index. There's the S&P 500. There are tons of indices, and you have the link there we provided in the last class to look up all these indices. And so when you're a portfolio manager or whatever, you have to look at the appropriate index to benchmark your performance with. Now, having said that, most people index their performance against the standard S&P 500. Okay, that's considered to be the most commonly used benchmark index, if you will. But however, if you're a large cap fund, then you might use another index that better reflects large cap funds. If you're a small cap fund, you might use a different index that is primarily based on small cap stocks. So it depends on what your philosophy is and finding an index that best reflects that philosophy. So if you are primarily in the large cap market, then you need to pick a large cap index to appropriately benchmark your performance. Like I said, at the end of the day, S&P 500 is the one that almost everybody uses to benchmark their performance. So that's sort of hopefully an answer to that question. What are bull and bear markets? So bull market is when markets are up. Bear markets are when markets are down. So the question has always been why bull and why bear? So here's how the story. The story goes that when bulls attack, I don't know if you've ever taken the time and watched how bulls charge, but they have their heads down and their horns out, and they sort of charge up, and they gore people or whatever they're trying to gore with their horns upwards. And so that's how this bull market came to be reflective of up markets, when things are going up and aggressive. Bulls are aggressive animals if you've seen them. And so that bull market comes to sort of symbolize up markets and when things are going upwards. And bear markets are when markets are going down, because again, if you've looked at National Geographic or any of these sites and you've seen how bears attack, they essentially grab you and pull you down, or grab whoever it is that they're trying to kill or hunt for food, sometimes a human being, they will pull them down. And so that's how bears came to be associated with bear markets or downward phases. So bear markets are when markets are down. Things are, so it's the sort of a negative connotation. So down markets, again, the question is what is down market? Down markets are when the index is down. Markets are going, overall markets are down. Again, measured with the S&P index. That's what indices do, is that it gives you the pulse of the market. So when we say markets are up, markets are down, again, a pretty good question there inside. The thing is, it means that when we say markets are up, that means that in most of the major indices, market indices are up. That means they went up from their previous value. That means it's an up market. Markets overall went up. And when it's down, it means that the indices broadly are closed below their previous values, which means the markets are down. So that's how you sort of categorize up markets and down markets. Okay. How do we, scroll down to that one. How do we use beta for investment? Should we choose, well, again, so the question is how do we use the beta for investment? Should we choose beta above 1 because it performs better as markets are better? It's not clear that you want to always choose beta greater than 1. Remember what beta greater than 1 implies. It means that it's riskier than markets. It's riskier than normal. So if you have an appetite for risk, then certainly you should do that. But to say that beta greater than 1 is a better strategy is not true, or better investment. No, it's not. It just simply means that you are comfortable taking more risks. When you invest in beta greater than 1 stock or mutual fund, that means you're taking more than the average risk on your portfolio. That means, yes, there's a chance you might earn more than the average market return, but you can also lose money. So when you take risks, that's the other side of the equation. So depending on your risk tolerance, you may actually not prefer to be on that side of the market. You may want to be in securities like for example, companies like, the big oil companies, for example, BP, British Petroleum, and these have typically betas of less than 1. Doesn't mean that these are bad investments. No, they're great investments. There are some really fantastic investments of companies who have betas less than 1. Because these are solid companies, they're large companies, they're doing well. So there's no such direct correlation with beta greater than 1 means a better investment or anything. No, it's totally reflective of risk, and how much risk you're comfortable taking should drive what kind of stocks or mutual funds you gravitate to. Okay, cool. All right, so now we move on to options. Okay, so turns out that you guys are all familiar with options, even though you may, these things that you get in the mail, mostly junk mail. Those are coupons, which, thank you, Michael, you actually took the trouble of finding a coupon. And so these are the kind of things we get in the mail, and these are options, right? So options are not always this hard to understand, esoteric financial investments. Turns out that you've been dealing with options most of your adult life, or maybe even before that, when you ordered pizza. And so here's an example of an option. So what does it tell you? If you have this coupon, you call in your order and you pay the price that's on the coupon. That's your price that you pay, and it usually has an expiration date. So if you don't use it by that date, it's useless. It expires. That's true also with financial options. So there's a lot of commonality between options that you may be quite familiar with and the kind of options that we are going to talk about in this class today. There's some differences, very small differences. One of the main differences between these options that you get in the mail and that you sometimes use, most of the times you probably don't, they expire unused. So the company sends out a bunch of these things, maybe hundreds of thousands of these, and few of, relatively smaller percentage of them get called in, and they're utilized. The rest of them are just, accumulate as junk somewhere in your trash. So these are free. You get them for free, right? You're obviously not going to pay to get these options, right? They just come in the mail and you deal with them. Most of the time you throw them away. Sometimes you use them. In a financial option, on the other hand, you actually pay to buy those options. They are relatively cheap to buy, but they're not free. Stock options are not free. You have to pay to buy them. They're traded. The options are traded, and they have prices. They have bid-ask prices, just like stocks. These are free. So the question is, why are these free? Because you're essentially doing the same kind of things. Options give you the right. This kind of a coupon gives you the right, but not the obligation, to exercise it and buy whatever it is for the stated price. That's the same thing you do with stock options. But in stock options, you pay. Here, this is free. So the question is, well, let's have this as a thought question. Why is this free and not stock options? Shouldn't stock options be free as well? Or shouldn't we have to pay for these coupons as well? Either way. Why not? What do you think? So I'd like to hear from you. We'll read out some answers before I give you the answer to that. Okay. So, and there's another example. When you purchase a house, for example, or you close on a house, as the official language is, you close on a house, and you put something as like a $500. I don't know if you've actually done this or you've seen your parents or friends go through this. You'll see that once you close, you have to make some kind of a good faith deposit, like a $500, $1,000, to sort of say that I'm not going to renege. Because when you close, it's more of a verbal agreement, right? You say, yes, we'll do it. We agree to the terms. But there's nothing legally that you've signed at that point, right? So technically, you can back out. People don't, but in order to make good on your verbal commitment, people usually put in a down payment, a non-refundable down payment, anything from $1,000 to $2,000, a few $1,000s, as a sign of good faith. I don't know if you know this, but this is quite common. And the idea is that if you do renege, then you lose that money. The seller gets that money. And that's an option. That's an option. So you're optioning to buy the house at the stated price, and the price of that option is the down payment or whatever, the good faith check that you write out. And then if you go through with the deal, then that money that you paid is adjusted against the price. If you don't, then you've just lost that money. Right? It's like a deposit, security deposit that you won't get back. So that's an example of an option. Broadly speaking, if you step back and generalize, any time you promise to buy something and you put in a token payment as a sign of good faith, that's an example of an option. Okay? So, and that happens quite often in different spheres. So with stock options in particular, you can see that, again, it's a legal contract between two parties. You know, all financial contracts, agreements are contracts. It's an agreement. Formal agreement is a contract. You being here in this class is a contract with us, with me, in terms of your performance, grades, and all that. That's a contract. You may not realize it. It's not formally signed document, but there's an agreement, right? The syllabus, for example, you may not have thought about this, but a syllabus typically is a contract between teacher and student. Therefore, I cannot, as an instructor, change terms of the agreement midway in the course, right? If I haven't committed to it in the syllabus, it would be unfair for me to suddenly change the rules of the game midway and say, oh, by the way, you know, I've changed the rules. Well, and that can cause problems because some of you will be unhappy and there'll be issues to deal with. So a syllabus typically is a contract. So there are contracts everywhere. That's all I'm trying to convey here. So stock option is a contract between two parties, the buyer and the seller. Options are always between two parties, buyer and seller of the option, for a fixed price over a given period of time. Like the pizza coupon example, these have finite periods after which it expires and we're done. You have to buy a new option contract after that. So do we have any response to? Nothing. Gosh, we're drawing a blank. All right. We'll give you some more time to think. So here's some of the ways to characterize a stock option, and it allows you, when you buy an option, purchasing an option allows you to buy or sell shares at the agreed upon price, which is called the strike price, and these options themselves can be traded. Okay, so these option certificates are tradable commodities, tradable securities. They are traded every day, like stocks. They have prices, the prices go up, down. And so over 95% of options markets, by the way, options markets are even larger than stock markets, in case you didn't know that. Option markets have way, way larger volume. They're larger in every dimension than equity markets, than the New York Stock Exchange. And that seems kind of counterintuitive, but it's true. Options markets are way larger than the equity or stock markets that we've talked about. So it's a large, you know, millions of dollars, billions of dollars are transacting in options markets every day. So maybe even trillions of dollars. So it's a huge, huge market, and bigger, like I said, than the stock markets, significantly bigger. And so there are, broadly speaking, there are what is called call options and put options. Okay, so call options are where you want to buy the underlying stock. So it's an agreement to buy underlying stock. When I say underlying, that means an option is for us. So when I buy IBM call option, for example, that means I am obliged. Well, I can if I want to, but I'm not obliged to buy IBM shares at an agreed upon price, which is the strike price, that's specified in the option contract at within a certain point in time before that option expires. Now, that gives me the right to exercise the option at that price if I want to, but I'm not obligated to do so. Just like with the pizza coupon example, you have the right to exercise it if you feel like pizza and you feel like, you know, getting your discount in the coupon, but you're not obligated to use it. You don't have to use it. But you can if you wish. It's your right, but not an obligation. The same thing is true here. Okay, so you have, and then put options are where you are, when you buy a put option on an underlying, on a stock, then like an IBM, for example, then you are committed to sell IBM's shares at the agreed upon price within that, before the option expires. Anytime before, but again, you're not obligated. You have the right, but not the obligation. So that's sort of how these things work. Calls are for buying shares, puts are for selling shares. Okay? Agreement to sell shares. It's kind of a little complicated because it's what is called a derivative security. You may have heard the term derivatives being applied. So options are derivatives because they derive their value from the stock. The stock itself on which these options are written are the main instruments. Options are derived from those main instruments, and therefore they're called derivative securities. They're derived. Their value is derived from the stocks. Okay. So when you get to the call option part, again, the formal definition, it gives you, when you're a holder of a call option, you buy a call option, it gives you, the holder, the buyer, the right but not the obligation to buy shares at the strike price. Now, each contract, each options contract is standardized to include 100 shares of the stock. So when you buy one contract, one call option contract, it entitles you, it gives you the right but not the obligation to exercise it if you want, and for 100 shares of that particular stock at that agreed upon price. So each contract is worth 100 shares. 100, again, the term is underlying shares. Underlying meaning the underlying stock on which that option is written. Okay? So here's an example. Let's assume that the current stock price of IBM is $183, and you buy one IBM March 185, which is the strike price call option. So currently IBM is trading at 183. If you exercise this call before March, then you can buy each share of IBM for $185. That's your contract. That's your call option strike. So given where IBM is currently, is it in your interest to exercise this option? What do you think? Yes, no, maybe? Yes?
It could depend on whether the market's in up or down trend for that stock.
No, so let me ask the question again. So you can go in the open market at this point and buy IBM for $183 a share. Possessing this call option entitles you to buy IBM shares at $185 a share. So given that situation, is it in your interest to exercise this option at this point in time? What do you think? Yes, no, yes?
No, because they're spending $2 per share more currently.
There's your answer. Very good. Yes. So you don't want to do it because right now, because it's what is called out of the money. Right now, you're better off just buying IBM shares at 183 because that option only entitles you to buy it at 185. And therefore, you're not going to exercise it right now because it'd be silly to, because you can buy it cheaper in the open market. Why exercise the call option to do so? But however, when will you, by the same token then, the corollary to this question is, when will it become optimal for you to exercise this option? What do you think? Yes?
If the stock goes up to $200, then it'll be a lot.
Yeah, I mean, not even 200. Let's say it goes up above 185, but enough to cover your purchase price. So let's say it goes up to 187, 188, 190. It might make sense for you to exercise it because then you can exercise it to buy IBM at $185 a share, where in the open market it's trading at 190. You can buy it at a discount, basically. That's what this option. So at that point, the option becomes in the money. So there are these terminologies that people use. When an option is out of the money, that means the strike price is below. For a call option, the strike price is below the current market price. When it's in the money, that means the strike price is above. Call option being in the money, that means the strike price, the current price is above the strike price. In other words, you can buy it at a discount, and that makes it worthwhile. That makes it worthwhile for you to, because something that's trading at $190 in the open market, you can exercise your call option and buy it at $185 in this case, cheaper than what you would have buy in the. Having said this, let me also tell you that hardly anybody ever does what I just told you. Okay? So people do not, very, very few, in fact, hardly anybody ever exchanges these options for stock. And the reason they don't is because the options themselves are priced commodity. So when these option contracts, so when the underlying share price goes up to 190, that call option contract itself is now trading at a much higher price than what you paid to buy it initially. And therefore, people simply sell it back for a profit, just like you would do with a stock. You can buy a stock, IBM stock, forget the option for a second. You can buy IBM at 183, and when it goes up to 190, you just sell it on the market, and you make $7 a share profit. Same thing with options contracts, call option contracts, is that you don't have to exchange it. What happens is when the underlying share price goes up, the call option contract also increases in value. And therefore, you can simply sell the option contract back in the market. It's a very liquid market, and you can make a significant return because the call option contract is now worth significantly more as a result of the fact that the underlying share has gone up in price. And therefore, that's what people do. The vast majority of options transactions are simply buying and selling these options contracts themselves. Hardly anybody exchanges them for stock. Okay? Any questions? Whole bunch. Does in the money mean that the stop option is a good buy? I don't know that I'd characterize. In the money simply means, as I said, in the money means for a call option that means that the current stock price for that option, current stock price is higher at a higher value than the strike price. Anytime that happens, that option contract is in the money. Now, whether that's a good deal to exercise, just because something is in the money doesn't mean you exercise it right away. Okay, so that's a different question altogether. So the definitionally, that's how it's defined. So when the opposite condition, you have a call option whose strike price is above the strike price is above the current market price, that means it's out of the money. So that's a definition. Whether that, that's a different question, right? So that's a definition of what is in the money and what is out of the money. Okay? A strike price, like I said, the strike price is the price, the agreed upon price. That is the trading price of as written on the contract the option contract. Right? That's so in this example, you bought a 185 strike option contract. So now the question is, how are these strike prices determined? So when a particular stock has options trading on them, there's an option committee that actually reviews the current prices of these of the underlying stock, and then finds values above and below that current stock price as strike price points, and then they sell those various contracts in the market with different strike prices. When we show you in the next class, we'll try to pull up. We'll have an example of these calls and puts, and you'll see how they're laid out. Then it'll get clearer as to how these are determined. If you use your call option when the current price is high, current stock price, I'm assuming, do you immediately make a profit from the stocks you just purchased? Okay, I don't quite understand what that question is implying, but so, okay, why are you, okay, so this actually I think begs the question as to why would you even use options? Why use options? Okay, so we are comfortable with understanding why you'd buy stocks, right? We understand that because you want to make money. You want to make your investment grow. So you invest in a company, you buy its shares. Hopefully, if you're right, then the stock price goes up. Therefore, the value of your investment increases. And then you can take profits by selling the stock, or you do whatever. You can hold on to it, whatever. We understand that. That's easy to grasp. Options are not that easy to understand. Believe me, these questions are very reasonable questions because they are not easy to. You'd be surprised how many faculty members here at Purdue with PhDs don't understand options, because it is just not that simple to see. So let's see, how do we explain this? So what is going on is that why do people use options? Options is very simply a leveraging strategy. So in options, so for example, let's take this. IBM's shares are almost $200 a share, right? So if you want to buy 100 shares of IBM at these prices, you're spending what, almost $20,000, right? $20,000 to buy 100 shares of IBM. I don't know about you, but I can tell you that not many of us have that kind of cash lying around just to put in, buy 100 shares, right? That becomes a problem, right? I mean, let's say you're an investor and you want to invest in the market, these high-priced shares, or something like Google or something that's $1,000 a share. I mean, think about it. 100 shares is going to cost you what, right? $100,000. So how many of us have that kind of money? So then what do? Does it mean then you can never buy these kind of, never have exposure to these kind of investments, even if you think they're good deals? No, you can do so with options. Why? Because option contracts are a fraction of the price of the stock. So when you buy, for example, this 185 one contract, which entitles you to control 100 underlying shares of IBM, that contract will cost you, I'm guessing about $400, $500, okay? Maybe $1,000. That's it. So with $1,000, you are effectively controlling 100 shares of IBM through the derivative contract. So now it becomes more affordable to own these investments because now through the option contract. So that's called leveraging. This idea of leveraging. So options allow you to leverage your investment. So it allows you to control a larger fraction of the market with a relatively smaller investment. Having said that, sounds really good, right? All good. As you know, everything has a trade-off. What is the downside of leveraging? When things go right with leveraging, it's a great strategy because you make your returns. I'll show you with a numerical example how that works. But intuitively, what do you think is the downside? With anything in life, there's always a good thing and a bad thing, right? There's on the one hand and on the other hand. What is on the other hand with leveraging? Anybody? And you can speak up if you want. Yes?
There's an expiration date, so if it's not in your favor at the expiration date, it's nothing you can do to take back your money.
Okay, it's like an insurance contract, right? So insurance contracts have an expiration date, and so with your health insurance contract, if it expires and you have a huge health bill, well, guess what? You don't. No, actually, that was not the answer I was looking for, although I will accept that as an answer. But what is, on the other hand, with leveraging, when things don't go your way, right? We always don't. We are. Lesson 101 in investing, things are not always going to go your way, right? In fact, they might go more often not go your way than go your way, and the goal is that in the net, you end up ahead. Well, so if they don't go your way, in leveraging, you're going to lose in percentage terms more than you would if you were to invest in the underlying security with your money. So leveraging, and this is a universal concept in leveraging has the habit of magnifying your gains. It also has the bad habit of magnifying your losses. And I think you'll understand this better when we have a numerical example, which should be coming up. I'm going to just... So let me just... Actually, let me... Don't we have the example?
Yeah, we do. Or I've got it up.
Yeah, leveraging option. There's got... I've moved on, then I'll come back. I moved ahead, then I'll get back. Okay, here you go. Go to the previous one, yeah. So here's an example. I think leveraging is best to understand. We'll go slow on this one. So how do you understand? Let's understand leveraging with this numerical example. So let's assume no commission, because commission charges simply just scales things up and down, so it doesn't change anything. So let's assume no commission charges. Current price of one Microsoft share is $31.19. You buy 10 Microsoft March 30 option contracts, trading at $1.27. Under 100 underlying contracts, that means you're paying 1,270. So because it's 100 shares, so you multiply that, so it's $1,270 that you paid to buy this one contract. And you, because one contract is valid for 100 shares, and the strike price of this contract that you just bought is $30. Okay, $30 strike. So when choice A is you buy and sell the option contracts only. Choice B is you buy the stock, which is the standard practice, right? You buy shares, you sell shares, etc. So choice A is the option strategy, which is the leveraging strategy. Choice B is the non-leveraging strategy, okay? The normal strategy, as we call it. I'm losing everything here. All right. So let's go ahead, forge on ahead. Okay, so two things can happen. Either the stock price goes up in value or it goes down in value, all right? So one of those two things happen. So let's assume the good scenario where Microsoft now goes up to 33.08 from 31 whatever and change 31.19 to 33.08 between now and March. It goes up a couple of dollars. Now, as I said, when the underlying stock price goes up, the call option value also goes up. So now the same contract that you bought for $1.27 per share, $1,270, is now trading at $2.50. It's gone up to $2.50. So the total value to you is $2,500 for the 100 underlying shares. So with your option strategy, your gain is now 25 minus 1270. That's what you paid. Current value, and it's 96, almost 97% in gains that you have with your option strategy. Things went your way. This is a good strategy, good thing. On the other hand, if you just bought shares, the non-leveraged strategy, you've made 3,308 minus 3119. It's 6% gain. Okay, do the math yourself. These are numbers. I'm not making this up. So this is the advantage of the leveraging that you did. Leveraging, things went your way, gains were magnified. In your option trade, you made an almost 97, almost doubled your money. Whereas if you just bought stocks, you just made a 6% gain. All right, let's look at the other side of this story. Let's look at the not so good. Now, this is the side where things didn't go your way. Right? This is the dark side of leveraging. Let's say the same option, you're approaching March, close to expiration. The stock price has not gone up; it's gone down to 28. Okay, $28 a share. The same call option contract has now gone down in value. What you paid $1.27 for is now trading at 30 cents. Okay, so that your value is $300 of that investment right now. The call option that you hold has market value of $300. You paid $12.70, remember. So your loss is 300 minus a straightforward return calculation. 300 minus 1270 divided by 1270. That's a minus 77% loss. Now, you didn't leverage. You just bought the stock straight up. Your loss is relatively meager, minus 10%. Right? This is leverage, my friends. So when things go your way, option strategy, leveraging gets you, a larger, significantly larger percentage gain. When things don't go your way, it gives you a larger percentage of loss relative to the non-leveraged strategy. That means that there is greater risk in trading in options than it is in standard non-option contracts. And that's why you're always warned that option trades are riskier than normal non-leveraged, just straight up trades. The downside of doing non-leveraged trades, of course, so people who are more risk averse, they would prefer the non-leveraged strategy because there your gains and losses are more muted. You're making less money, but you're losing less money. When you're risk averse by nature, that is a welcome option than to take chances where you might make a lot more in percentage, but you might also lose a lot more in percentage terms, as this example shows us. Questions? I'm sure there are questions, right? Lots. Okay, let's deal with them. Pizza equals options. All right, a nice picture. Thank you. Okay. Gabriel, what up, buddy? Okay. How does the strike price of the call option change relative to the stock? The strike price does not change. The strike price is fixed for that contract. Once you buy the contract with that strike, the strike does not change. Strike is fixed for the life of that contract. Okay. So what I'm understanding is that the option market is more extreme stock market. So a small gain stock market would be much greater in the option market. Is this a good analysis of options? It's a decent analysis of options. Options give you another way to trade. Let's put it this way. This is how I would characterize it. Why do options markets exist? Options markets give you an alternative to trading. So it's not for everybody. It's not for everybody. I'll be the first one to tell you. It is a great option, and millions of people trading trillions of dollars invest in it every day, but it's not for everybody. Just like dog racing, dog track racing is not for everybody, not for me, not for some of you. Not everything is for everybody, right? It gives you an option. It gives you, options give you an option, right? Options give you another choice. It gives you another way to invest. That's all it is, okay? And the leveraging strategy might work. And there are ways, I'll talk more in the next class about how you can actually work with, even if you're risk averse, you can minimize risk by following certain common sense rules. We'll talk about that next day. Let me answer a couple more questions. And who issues options originally? There's an option committee that decides. Not every stock has options trading on them. That's another thing you got to keep in mind. Not every stock has options. Not every stock publicly traded has options trading on them. Yeah, a stock has to have certain amount of popularity and visibility for options to be written on them. So that's one thing you got to keep in mind. All right, one more. Hang in there. One more. We'll be done. What happens to the March call option after the end of March? It dies. It's dead and buried and gone. Third week of a month. So option expiry for a month is always on the third Friday of a given month. So if it's a March option, it expires on the third Friday at market's close of that month. Third Friday is when they expire. After that, they're done. They're finished. They're in the, like your pizza coupons after they expire. They're in the trash.